Hello everyone and welcome to another video of this course. In this lesson, we'll be learning about financial reporting and disclosures. And under that, we'll be looking at key financial statements elements in oil and gas accounting, reserve reporting, and impairment testing. So without further ado, let us move on. What is disclosure? Disclosure refers to the process of providing detailed information about an organization's performance, position, and cash flows. The information typically includes financial statements, notes to the financial statements, and other relevant data that helps bring stakeholders to understand the health and operational results of the entity, along with some risks that may come along. So, what are types of financial disclosure? Different types of financial disclosure include annual reports, quarterly reports, earnings, releases, and regulatory filings. There are several main types of financial disclosures. We have annual reports, quarterly reports, earnings releases, and other regulatory filings. So let's look at each of these types of financial disclosures one after the other. Annual reports. Annual reports provide a comprehensive overview of a company's financial performance and activities over the past year. They typically include audited financial statements, a management discussion and analysis, and information about the company's operations, strategy, and the corporate governance. Quarterly reports. Quarterly reports, or Form 10Q, as is often called in the US, offer interim updates on a company's financial condition and results of operations for each fiscal quarter. These reports are less detailed than annual reports, but still provide information including financial statements, management's discussion of financial performance, and updates on significant events. Earning releases. Earning releases are periodic announcements made by companies to report their financial performance for a specific period, usually every quarter. These releases highlight key financial metrics such as revenue, earnings per share, and profit margins, often accompanied by brief commentary from management. And we have other regulatory filings. Regulatory filings are required documents submitted to the regulatory authorities, such as the SEC, in the US to comply with legal and reporting requirements. Key examples include the forms mentioned above, from 10Q or from 10K, though there are many other different types of forms. For example, companies must disclose when additional shares have been acquired by key internal stakeholders. Now let us look at financial statements in oil and gas. Key elements in financial statements in oil and gas include assets, liabilities, equity, income, and expenses, with specific accounting considerations for the industry's unique characteristics. This includes accounting for reserves, revenue recognition, exploration and development costs, and depletion, depreciation, and amortization. So, what are assets? Oil and gas companies hold significant assets like oil and gas reserves, exploration and development assets, and equipment. A key element is reserve accounting, which involves estimating and accounting for economically recoverable oil and gas. Liabilities. Liabilities include outstanding debt, restoration obligations for decommissioning and cleanup, and potential environmental remediation costs. Equity. Equity represents the ownership interest in the company, reflecting the net worth of the company after liabilities are deducted from assets. And then we have income. generated primarily from the sales of oil and gas, but also potentially from other activities like exploration, development, and transportation. Revenue recognition can be complex, especially in joint ventures or with product sharing agreements. Expenses. Expenses include costs associated with exploration, development, production, transportation, and other operational activities. A significant expense is depreciation, depletion, and amortization, which allocates the cost of reserves and assets over their useful lives. Now we'll be looking at reserve reporting. An oil and gas reserve report quantifies the amount of oil and gas that can be extracted economically from a given field or area. It is a crucial document for investing decisions and regulatory compliance. The report typically includes estimation of proven, probable, and possible reserves categorized by uncertainty levels, and may also include information on cash flow projections and economic valuation. Now, what is the purpose of reserve reporting? Reserve reports provide a snapshot of an oil and gas company's potential future production and profitability, influencing investment decisions and regulatory reporting requirements. What is in a reserve report? What should it contain? A typical reserve report typically includes reserve categories such as the proven IP, that is reservoirs that can be extracted with a high degree of certainty; probable, reservoirs that have a reasonable chance of being recovered; possible, reservoirs that have a low chance of recovery. And then we have production forecast, estimates of future oil and gas production based on engineering analysis and income factors. Another report you should include is economic valuation, calculations of the potential economic value of the reserves, considering factors like production costs and commodity prices. And then we have cash flow projections, forecast of future cash inflows and outflows associated with the reserve. Finally, we'll be moving on to impairment testing. Impairment testing in the oil and gas industry, especially for upstream companies, involves regularly assessing the value of exploration and production assets against their carrying amounts, particularly in light of fluctuating oil and gas prices. This testing, often based on GAAP guidelines, helps determine if an asset is impaired, meaning its value has declined below its book value. Now, why is impairment testing important? 1, because of fluctuating market prices. Oil and gas prices are notoriously volatile, and this makes it difficult or essential to regularly reassess asset values. Asset specifics. Number 2. For upstream companies, exploration and production assets are particularly susceptible to impairment due to factors like declining reserve climates, changes in production costs, or adverse market conditions. And number 3, accounting standards. Both the GAAP and IFRS have detailed guidelines for impairment testing, ensuring consistency and transparency. What are the steps in impairment testing? Number 1, identifying impairment indicators. 2, estimating recoverable amounts. And 3, comparing carrying amounts to recoverable amounts. More details of this are in the lesson notes. So with this, we have come to the end of this lesson. In the next module, we will be learning about environmental and sustainability reporting. Thank you once again for watching this video. I will see you in the next video. Bye for now.